The question is, how do we continuously increase generational wealth? I'll talk to you about this from the perspective of a client that we're working with and from some of the cases we've been part of in the past. A good example of this would be a patriarch and his wife, 2 sons, and maybe 5 grandchildren. And if you think about this, the older gentleman is in his 70s, his wife is in his 60s, and the kids are in their 40s. The grandchildren are all under 10 years old. A good way to now increase generational wealth for this individual and this family would be to insure every single member of their family. The idea behind this is that every time, God forbid, somebody passes away, they would leave the family with a chunk of money as a life insurance proceed, which basically goes into the family account. So think about a net worth of a family which is about $100 million US. If an individual in the family is covered for $10 million US each, every time, God forbid, somebody passes away, they leave the family with 10% more than the family was initially valued at to begin with. This ensures that while in the beginning the generation was just 2 individuals with a net worth of 100 million, as the years go by and the number of mouths to feed consistently increase, so does the net worth of the family or the balance or the bank balance of the same family. This ensures that regardless of what happens over the years, the amount of money available to take care of their rising expenses and their rising needs continue to grow as well. Another interesting thing to think about with your life insurance policies is inflation, right? If you think about the same family that we mentioned earlier, the cost of education for the patriarch back in the 50s or the 60s was a lot cheaper than what the cost of education is today for his grandchildren. And this is only going to keep increasing. And this is essentially inflation. Also, as a patriarch of that family and that family business, the cost associated with payroll for their staff, maybe even 20 years ago, would not be anywhere near what it costs today for them to have the same operation running. And the third thing to consider, of course, is their family expenses. Regular monthly expenses, whether it is lifestyle, whether it's school fees, whether it's household, have all gone up over the years, and this is just the depreciating buying power of money. A life insurance policy appropriately put in place for every single member of a family would allow them to take care of the rising inflation costs as well as the growing number of family members as well. One common thing I've seen amongst most high net worth families is when they've reached a certain level of affluence, there's always a thought process over there about how they could give back to causes that are dear to them. Some of them have actually created foundations and have front-ended charities that they financially support themselves. So one of the common practices that I've noticed with the affluent world is to have a life insurance policy in place and to ensure that their charities of their choice consistently receive the regular monthly annual donations that they were accustomed to even on the demise of the patriarch. And how they do that is they assign a life insurance policy to the name of the patriarch. So when he or she, God forbid, passes away, then that money is paid out as a lump sum, the income from which continues to sustain and support the charities along the way. A question I get asked most often is, when is the best time to buy a life insurance policy? I'm going to go back to my example of my patriarch with his 2 sons and his 5 grandchildren. And if you think about this structure, if the patriarch has to put in place a $50 million life insurance policy today, this is going to cost him a single premium of $32 million US. If his son, who is 42 years old, has to put in place the same $50 million life insurance policy, the single premium associated with that is just $8 million US. That means it is 4 times more expensive for a 65, 70-year-old to purchase that same $50 million US policy than it is for a son who is 42 years old. And in this kind of a structure, when you know eventually you're going to buy that $50 million policy, would you rather pay $8 million for it, or would you rather pay $32 million for it?